Good evening, everyone. I hope you're having a good time. Thank you for making it on time for this session, where we will delve into matters governance. Our facilitator for the day, Sharon June Akinyi, I hope I have not butchered your name, is online already, and she's joined the call. And I'm looking forward to a good session. I will now hand over to Sharon. Sharon, if you can hear me, please take over, do an introduction, and you can begin the session.
Hi, Andrew. Thank you so much. I don't know if I should switch on my camera for now before we start so that you just put the face to the voice. Is that okay?
Yes, that's fine. At least to put a face to the name.
So I'm Sharon June Akinyi. Andrew, you are right in pronunciation. My names are very simple. Sharon June Akinyi, currently based in Nairobi. I'll be the one to facilitate today's session. I'm so happy to be here. Definitely, I'm extremely intrigued by the works we are doing in our different fields around insurtech, around healthcare, around financial advisory, etc. I would really, before I introduce myself, I'll do it as I'm doing my presentation, to have an interactive session. I'm already happy with Mwenda's question with reference to whether we have a board or you have, should you even have a board in the first place at this level? So those are some of the areas we are going to tackle. If it's okay, I'll switch off my camera and then I'll proceed to my presentation. Yeah, okay. Okay, let me know once you're able to see my screen, then we can proceed.
We are able to view it.
Thank you so much. Okay, so welcome to our session for today with reference to governance and really laying the foundation on trust, control, and growth, specifically also being startups. I think sometimes people really put so much emphasis and make it look very difficult when it comes to the word governance. But once we go through the slides and once we go through the lessons, you'll be able to realize some of these things you're already doing them within your space or within your organization, but it's just to make emphasis or how can we do them better. Yeah. So I have 16 years of experience spanning in telecommunications, specifically that's Airtel and MTN. I was in Zambia for approximately 10 years. I've also worked within the financial services, KPMG as a forensic consultant, and then Ernst & Young as an external auditor, where I really garnered expertise in audit, compliance, risk management, and overall governance. Like I've said, I'm currently the head of internal audit and risk at Airtel Kenya. I'm also a board member at Vision Fund Microfinance Bank in Tanzania, where I also chair the audit committee. Here in Kenya, I sit on the audit and risk committee of the Office of the Control of Budget. This is it's a parastatal. It's within the public sector. Contribution-wise, I contribute significantly across Boardroom Africa. So these are institutions, or should I say, member institutions. We have Institute of Directors, and then we have Women on Boards Network, which is based in Kenya. I think my purpose mainly is to unravel what really governance is, create impact, through transformational, by finding gaps, building solutions. Overall, I think the word I am an auditor is quite key. And audit is, in this day and era, audit should be an enabler. Yeah, we shouldn't really be fault finding. We should walk with you the journey as you're starting up your entities, as you're scaling up. We should be there to support with reference to what can you do better to ensure that you're not exposed, either from a revenue perspective or even from a reputational damage. And that's what I believe audit and risk really should contribute towards your journey. So how we'll proceed, please stop me. I think, Andrew, they can stop me at any point to ask questions. You're able to assist me because I'm not able to view the hand that is raised. on any slide so that we are able to articulate, or I'm able to articulate a particular point, or I can answer a question if that comes through.
That
So with
sounds
that,
good.
yes, thanks, Andrew. So with that, that's my profile. Overview of the coursework. And this is just for starters. I believe as we go on, you'll be able to engage. I'll be able to share my details, or Andrew will be able to share my details later on, where you have questions or where you think maybe you need some form of clarity, you'll be able to ask. So we'll look at what is really governance and why does it matter at this stage, sorry. And then what is your role as a founder? What decision rights and operational oversight do you need to undertake? And as Mwenda asked, is it key to have a board at this point? What's the difference between an advisory board and a fiduciary board? When do you need them? Why do you need them? And who in particular actually should you engage at this point? Financial hygiene in terms of budgeting, controls, audit reporting, around finances is also what we are going to close our session with. With that, I'll start with the first area. What is really governance? Why does it matter? We have a framework on the clarity of roles and decision making, which is called the RACI, the RACI framework. And then the scalability and investor readiness. I think one person asked me, how do we package ourselves for investors at this point? And probably we'll look at how governance helps in that particular aspect. So the first question I'll ask before we can proceed, and maybe we can take maybe 2 to 5 minutes to just give, so that I can get an understanding of where we are with reference to governance. So where is your governance today with however you understand what really governance is? Are you at the point where point A is governance, we'll get it later? Maybe we are focused on other things. Point B, we have some form of structure, but it lives in somebody's or someone's Google Drive. Point C is we are learning to balance agility and accountability. And D is governance is our growth enabler. So maybe Andrew, you can assist. I don't know if we can have a poll on this one. Then we can have the members just saying where they are. Okay, that's good. So at least I think majority are on C. We are learning to balance agility and accountability, which is very encouraging, at least to know that we are getting there. Yeah, and maybe A and B is something we would have really had people who maybe weren't doing anything at all. So also that's fine. And like I've said, I think it's good most of us are on C and clearly have an idea of what really governance is. So governance really is how you make decisions, who has the power to make them, how you manage your resources, and how you really hold each other accountable. Within my presentation, you'll see a lot of mention of accountability. So an analogy which I really wanted us to look at is, with reference to building a house and having a blueprint. Governance is the blueprint that ensures that you add a second story, or when you're scaling up without the whole thing collapsing. Because remember, as a startup, it is what it is. It's a startup, but with the vision that you're going to scale up. And like most of you have said, their intentions are. So governance is your groundwork, it's your blueprint, it's the culture you create from the word go. So if there's any instances of bad governance, then the cracks will start showing. So you start small, and you ask yourself, why now? Because at startup level, like I've said, that's why you create a culture that is going to enable your business to proceed through during even tough times. And at times where, there's change in environmental changes, fiscal changes, your level of governance will really hold your business together. So in addition to that, governance is a trust signal. So most investors are going to come and ask, for example, we want your financials, we want your reports that really show what you're doing. So it really it's a good signal that you are reliable and you're a well-managed company, and it proves to be a safe bet. And like I've said, I've emphasized good governance is a foundation and it's not a decoration. So it's very, very key that governance, as you're scaling up and you're focusing on developing of your products, you're focusing on developing, increasing your footprints, governance should be at the side of what you're doing. And it is also very common, maybe now into our next slide, to show that what really startups are focused on, and it is normal, and it is okay. But now what we are saying is that you need to embrace governance as you scale up. So startups are more focused on product development and testing the markets, and therefore you'll have a bias to really put governance as a byproduct of what you're doing. So you typically put little effort in the organizational development, and some of the few characteristics which are common across is that you find small multitasking teams, you find a high degree of informality, a centralized decision making specifically and most commonly by the founders, and you find an autocratic leadership style because the founders are the ones who carry the vision. So it is normal and it is okay, but now when you're scaling up, that needs to change. Founders are fully involved in operations with limited needs for checks and balances, and everyone knows everything. And then in most instances, a single owner or couple of individuals, founders personally control every aspect of the business. A good example that I just wanted us to start with is a fintech without spending approvals. So when I say spending approvals, your DOAs, you don't have a defined DOA, found team members signing small vendor contracts independently. By the time it was the end of the year, we had duplicate services costs, and this definitely had a financial impact to the business. So a simple basic approval policy could have prevented all this. And you see, unfortunately for startups, it is inevitable also to do things as you go. I think there's somebody who's made mention to say that things change today, it's this, in 3 months, it's a totally different ballgame. But how do you embrace that? You have to ensure that as you're scaling up, you're really looking at, okay, we need to change even, for example, approval processes. Because if you're handling $10,000 now, and in 3 months you're handling $1 million, then ideally you should have a more robust DOA at the point where you're handling 1 million. And that's why I made mention to say that as you're scaling up, you really also need to scale up your governance level, because it's different when you're starting and when you've scaled up, or maybe you're in existence for 2 years. So these are some of the characteristics which I wanted to highlight, which I believe most of you have encountered. But now you ask yourself, so Sharon, what next? Yeah. So importance of governance as a foundation. I think it's Pete who asked, how do we have investor confidence? So investors, I'm sure from your experience, they just don't bet on ideas. Yeah, they're really investing in a team and its ability to really execute what your vision and your mission is, and your respective objectives. So strong governance will really clear signal that a startup is serious, it's well managed, you have defined processes, you have defined procedures. They don't need to be robust at a starting point, but at least they need to exist. And it's as basic as having a cash flow procedure to say, this is how we prepare cash flows and all that. So a formal board structure, or can I say at a startup level, an advisory board, clear financial reporting, and defined decision making is very key. That is going to really show potential investors that their capital will be responsibly utilized. And that is where building investor confidence, at least you're able to show them that this is, and things which are actually documented and have been done. In audit, we normally say, if it's not documented, it's not done. And once an investor comes in and you're able to present all this, then it ideally should build the investor confidence. And it's upon them now to do their due diligence to see actually if these things are they're factual and they're true. Governance will enhance strategic decision making and accountability. So here, when roles and responsibilities are really defined, and performance metrics are clearly defined, it ensures that leadership really is accountable for its decisions, and you're able to make reference to particular metrics that you've set. And then also this is going to foster a culture of responsibility. Remember, at startup level, the founders have significant cultural influence on how businesses are run. So if you're a founder who doesn't have clearly defined metrics or performance, or you don't even have trackers, then that is creating a culture of no accountability, and you're not able to even track some of the activities that you're doing. So it's important that this is done, and performance metrics are just extracts from your strategic visions and decisions that you make. Governance is also key to manage risk and ensure compliance. So I think Wenda mentioned, and Wenda, I'm going to make reference to you because your introduction was quite relevant to my presentation. So startups will operate in a dynamic, and Wenda said that in 3 months things totally change, and therefore you often you're always operating in an uncertain environment. So good governance will really hold forth in terms of your controls and risk management. You'll be able to identify and assess and mitigate potential threats. One area where people make mistakes, they think that risk management is only done when you've scaled up and when you're big and when you have more than 1,000 or 2,000 employees. But no, risk management is actually even best when you're doing a startup. So you're able to foresee some of the risks that you might encounter. So a good example is if you're a startup now, we were not able to see COVID, yeah? We were not able to see the different wars that we have, but they significantly impacted our businesses. So having a simple risk register to just articulate what are some of the risks. For example, those who are in health tech, what are some of the risks you currently face and you may face in future? So just breaking them down and having that particular risk register is very important, and tracking it. Yeah, I know for founders you have so much on your plate, but we'll come to a presentation where I have in terms of really delegation, and maybe that's where also your advisory board would come in, especially depending on the skills and expertise you've brought on board from an advisory level. The last one, in terms of importance of governance, is really to facilitate scalability and prevent founder-related issues. So what I mean here is that governance will provide structure needed to scale effectively. It will help professionalize the organization. And it is inevitable for founders to do everything, because at that point you're wearing different hats. But from your introduction as in today's session, most of you are either in 1 year or 2 years existence. So I'm sure probably you passed through the stage where you wear so many hats, and some things are so informally done. But at this point, it's very important to create formal processes, for example, hiring processes, financial management, and operational procedures. And just to give an example, I had a friend of mine who just started, it's a startup because it's an audit firm. It's nothing specialized, but it's an audit firm. And he told me that he spent almost 1 million Kenya shilling trying to get one of his friends to develop an ERP for him to be able to dispense it to his customers. And you see, the only challenge which he faced was that he used a friend, he didn't do his due diligence. He didn't really get to understand if this person is actually qualified to do it, but because it was a friend who he trusted, then he gave out that particular assignment. So when he came back to me, he was like, Sharon, I really need you to help me draft an RFP, and if we can really get professionals to bid and the whole process. So you see, for him, he's already lost, at that point, he's already lost 1 million shillings under the water because he used a friend who he didn't do due diligence. So it doesn't really harm if we create a formal process for most of these things that we do to ensure that we don't get burnt at this particular point. Any questions before I move on to the next slide, in terms of importance of governance, or any contributions or any comments?
Hello?
Yes, please.
No, just a comment to say that I think that is very, very important. And I have noted some different things we have the capacity to do, but sometimes we do not formalize. You stay in our head. You talk about the risk. You know, we talk every day about the risk we face, but we just don't put it down on a paper. Also on KPI, on also on process, for some process, you know, sometimes we start some process, but I think it should be very, very important to take a little time to even put it down and, you know, just to say that, okay, sometimes, as you said, an investor can think that you don't have it because just you don't have a document name procedure. And I'm just commenting that it's something that we will do because it can be not that difficult to do because sometimes it's already done, it's already put it in place. You have maybe to have a little scheme to put it on a paper, and it's okay for a beginning.
Yes, yes. And you see, and that's why I said it's inevitable as a founder to wear so many hats. And you see, at this particular stage, you really want to minimize your spend. And that's why if somebody tells you need to hire an internal auditor or an auditor at this point, you think twice about it because of the cost involved in it. And that's why it's very key to, when you're choosing your advisory board, you choose people or you select people who have expertise in different fields. And from my experience, most of the time you find people volunteering because also it helps with their portfolio to become advisory members, or even if they're not volunteering, but the stipend is quite small in comparison to a fiduciary board member. And it doesn't harm to also engage. For example, you're saying you have risks, but you have no idea of how a risk register is. It doesn't harm to engage people within this field. And believe you me, and maybe if you've experienced it, there's so many people who are willing to help at a particular point with even just doing for you a risk register. Yeah, as long as you can, as long as you can ask. And I think with this kind of sessions, you're able to get exposed, and thanks to FSD, to get exposed to expertise who are willing to help without even getting paid, because we all understand the pain or the struggles or the difficulties or the challenges that startups do face at this point. So thank you so much. Should be Virginia, is it? Did I pronounce it well? Sorry if I butchered your name.
Yes.
Sorry, yeah. Okay. Andrew, any hands? Should we proceed?
Yes, I think we should proceed. I'll notify you of any hands.
Okay, thank you. Okay, so we talked about the RACI, the RACI framework. So here, we are looking at clarity of roles and decision making. So in early stages, you find that founders and co-founders really often wear many hats. But as the team grows, the lack of clarity leads to overlap and confusion. And this is mainly where we don't have a good communication structure, or we still don't have clear roles and responsibilities, especially between the founder and the co-founders, because you all can't be CEOs, neither can you all be COOs, or neither can you all be CFOs. It has to, the roles and responsibilities have to be defined from the onset. And then if you don't have clarity, confusion will definitely arise. And especially if you have a team. And a team can be as big as 2 people. Yeah, that's still your team. And if you already create confusion as you start, you can imagine the culture that is being communicated across. So who approves spending? Who talks to investors? who manages product versus operations. You know, defining these roles very early is very, very key, and you really avoid the chaos and the embarrassment, I believe, as founders and as, you know, co-founders. So for example, define that the CEO will definitely be doing a lot of business development, fundraising and external partnership. And while the COO will run the day-to-day operations, and then we have the CFO or even a finance lead, depending on the titles you have, will handle the budgets, accounting, reporting, and cash flow management. So the RACI framework really defines who is responsible, who is accountable, so the ultimate owner of the decision or the task, who is consulted. So consulted here can be your legal team, your, you know, your risk experts, people who have got expertise in their different fields and maybe separate to what you're you're specialized in. Then you have people who are just being informed. So people who need to be kept in the loop, they don't really need influence in the decision. So if you look back at your team within your respective organization, do you have clear guidelines on the responsibility? Who is accountable at what point? Who should be consulted at a particular point also? And then who are the team members who should just be kept in the loop? Those are people who are just being informed. So with this framework, you're able to articulate, or you're able to clearly define the roles and responsibilities within the organization. And sometimes you find, from my experience, especially working with SMEs, sorry, you find the founder will give one instruction and then the co-founder will give a separate instruction to one person. So this person is left confused, and ideally, most of the time, they actually will not even perform that task. But if we have a clear guideline as to who should do what, then we really avoid some of this lack of clarity, which really leads to overlapping and confusion. So I hope that is clear and that has been emphasized. So scalability and investor readiness. So here, a good example we have is a Kenyan e-commerce startup failed to close series of funding because its financial records were a mix with personal and business accounts, which is very common, and I've seen it with the startups. Once they separated finances, implemented reporting and formed an advisory board, investor confidence returned. So why does this really matter? Because growth breaks weak systems. And remember, as we started, I said, you must have a very strong blueprint of your foundation so that when you're scaling, governance must evolve from that ad hoc founder-led process to a really repeatable structure, which will really support your scaling up. So for example, at 10 employees, payroll can be done manually using an Excel sheet, for example. However, if you scale up to 100 employees, you can't really use Excel sheet, or you can't do it manually. You need to consider investing in a payroll system or an HR system where approvals and internal controls are really effective. At seed stage, another example is that contracts may be informal, though that could be also risky. However, when you scale up and you get to a different series, you need to have legal templates, you need signing authorities. This is where you define your DOAs, and then you need to have audit-ready records. So investors don't just back great products, they really back disciplined teams, and that weak governance is a red flag, and strong governance increases valuation and trust. What I normally encourage organization is that you can't start everything at the same time. However, once you define your vision, you already know where you want to be, you can have a strategy, and at that time also, you can also start implementing your governance structures. You can say maybe in the next 5-6 years, I need to have, these particular people, I need to have these people to support my business, I need to have a defined legal procedures. You need to put in things in place, because as you scale up, then things change, and then you're exposed to even high, exposed to reputational damage just in case you don't do it well. And we all know what reputational damage at this point can really do to our businesses. It can cripple to a point of, completely shutting down. So it is very important for you to always have that in mind So what will investors really check on? And from an experience we've had, when I was working for KPMG, we used to get quite a lot of investor requests to do a lot of due diligences on startups or even foundations, even in the NGO sector that needed funding. And our due diligences were very, what was coming out was really the lack of financial reporting. And you go in, you find people have said, in this month, we've spent this month, well, this much. But when you request for supporting documentation, there's nothing. So now how do we confirm that that spend was actually attributed to the, or was articulate, or was in relation to the business operations? Yeah. So investors really are very, very strong in financial reporting. They're also strong on oversight. Is there functioning advisory? We'll look at that in the next session. And then who signs the, who owns strategy? Do you have the basics in terms of your, you know, your what do you call it? Your structure as a business, yeah? Your organogram as a business. Is it well defined? Who does what? Who's responsible? Because you can't do everything, yeah? And when investors come, those are the key things they really want to look at. Before they can even commit their funds to the respective businesses. So a case study, which we have for discussion today, and please ask questions. And I think maybe you've all seen some of the commonalities of startups. So a fintech once held in West Africa, we didn't put the name. It was aimed to build a unified payment network to make a cross-border transaction seamless. After raising an impressive $86 million, it collapsed in 2023, revealing governance vacuum that allowed for alleged widespread deception and financial matters that were not really attributable to the business. So key governance failures, which we picked from this particular scenario or case study, is that financial mismanagement. So we have weak controls, which allowed the CEO to misuse funds. Monthly salary was high, diversion of personal use, and then unaccounted for funds of 25 million. Remember what I made mention? You spend, but you don't account for it, or there's no form of documentation as to what that spend is really relating to. And it's easier said than done, but it is doable, especially when you have proper structures. You are able to be accountable for some of the funds that are used within the business. Then they had also issues of regulatory non-compliance, so they operated without proper licenses. The Bank of Ghana ordered it to cease operations. Then they had weak board and investor oversight. So investors failed to verify growth claims. The board acted too late after fake it till you make it culture collapsed and trust. So there's usually that euphoria when startups start, and you're very eager and it's a beautiful concept and you're really, really pushing for this. But then you forget the basics that come in with accountability in terms of governance. So a combination of fabricated metrics, financial impropriety, and regulatory breaches really led to a complete loss of trust and ultimate collapse of the company. We look at another case within here, and we've named it because it's public record, where non-compliance of regulatory really impacted them, didn't shut them down, but had a significant impact on them. So the fintech officially shut down its operations. The failure not only resulted in loss of millions in investor capital, but also served as a stark lesson for the startups on critical importance of robust governance, founder accountability, and meaningful investor due diligence. So this is, it might seem easier when it's on the other side, but it's very, very important to really engage, ask questions where you're not sure, from a regulatory perspective, from a financial perspective, and even just from an operational perspective, as some of the things that you're doing legally supposed to be done. And if not sure, we have so many channels to which you can also get some form of assistance or some form of feedback. I don't know if we have any questions. Yes, someone raised their hand.
Yeah, the question I have for this case study is that there were so many governance failures. Uh, so do you think, the amount of money they raised, I think the whole due diligence process on the VC's side, also, there was something missing?
Yes, of course, definitely. Like I think I've made mention in terms of there was no meaningful investor due diligence that was done. So I've encountered so many cases where the founders, the investors, they really focus on the product. And being Africa, and we have the spotlight at this point in our lives where Africa is the place to be with reference to tech and ecosystem. Uh, and we forget the basics, like I said, on governance. How are we spending this money? Yeah, 86 million is a lot for it to just collapse in a few years' time. And also when you see the founder is very, if you see as a founder, you're very good at raising funds, I would highly recommend you even get qualified people to manage these funds for you rather than yourself. Because if it was good governance and the CEO is able to pay themselves that monthly salary, then there's a problem. Even with the investors themselves, because as investors, you're ideally supposed to have interest in how the business is performing. But for a startup, and from also my experience, you find startups, founders really actually go without salaries for the longest until you're able to break even, or at some point where you're able to afford to actually pay yourselves this much of amount. So for this particular case study, it was just not a founder issue. It was both ways. Even that if they had an advisory board, then but you'll come to see the difference between an advisory board and a fiduciary board, and what the responsibilities are, and what the fiduciary duties are in comparison to, being an advisory board. So in this instance, if they had an advisory board, I'm sure the advisory board had no fiduciary duty to tell the CEO not to spend that much money.
No,
Yeah.
but my fundamental question is that, you see, the CEO or the management is the interested party, right? So, and in this particular case, it may look like, something funny, but the CEO is the one who came out as a winner, you know, making
Yeah,
so much
but you see
money
the
with
business
nothing.
collapsed at the end of
Yeah,
it
no,
all.
no, I agree. So who is the stakeholder? The control, the check and balance has to be there. So when someone is putting money, are they, enforcing a board governance? Are they going through the due diligence? Because that's the perspective which the stakeholder is supposed to bring in, either the regulator or the shareholders, right? Or the, independent directors on the board. So they are
But you
supposed
see,
to balance out, because you see, management in most of the cases are going to be aggressive about business because they are dealing with risks. When we
Definitely.
talk about, executives, they are dealing with product risk, they are dealing with market risk. So they are handling risk day in and day out. And sometimes they prioritize about which is the bigger risk to handle, right? If business has to sustain, and if there are hundreds of risks, you start with some of the bigger risks coming down to the smaller risks, right? For example, having an HR process to hire is great, but that may not be, very high on the priority for the management because they have to deliver on the KPIs, right? And I fully agree with your point that the management needs to be aware and they have to work on, the long tail because it is important for business. But that's where the check and balance comes into the picture, and the balance has to come from the stakeholders, the independent directors, the investors, the regulators, and especially if this is the amount of money which is involved, $86 million. Someone wrote the check without even checking those things.
Yeah.
That's how it appears, in this case.
yeah,
Okay, I think
can I
that's it. Yes, please go on.
put in some 2 cents?
Okay. Yes, we can.
Yeah. So I think on 20 there, I think that investors just closed their eyes and gave out money to a bunch of people. And right now, a lot of people are struggling because they can't raise, because the chickens are now coming home to roost, and the investors are like, oh hell, everything is breaking loose. And these are the things that they are seeing now. So there was just a time where people gave money while they have closed their eyes. I don't think that some of these things can happen now. We have gotten small money, but the level of scrutiny that I've seen, including analysis of bank accounts and analysis of every payment and getting proof of every payment at the point. Maybe it's just different investors have become much stricter now. But I think that there was some times where investors were just giving money. And that time has really costed the new entrepreneurs in the African market. And
Right.
I even remember in 2012, I think, no, in 2014 there, when I was just leaving school, I joined a startup based out of Kenya in maternal health. And he was really lucky to raise a lot of money, the founder, but he blew that money out. He got 600,000, for example, from USAID. They misused the money until USAID did not disburse more than they actually pulled back some of the money. So I think that these controls are really important, and I think that investors now are really, really looking. In the past, there was gaps, in my opinion.
Yeah. Yeah. No, I completely agree with you. Completely. And like you said, now it's the onus is on today's investors who now, like we are in this room, we're really trying to put in controls, but it's difficult. And the scrutiny is not easy for someone to come and tell me, prove to me that you've actually made this amount of money and that this spent is authentic. Yeah. So thank you so much for that point and for articulating that quite well. Any other question or comments? I think we had somebody else. I don't know, Andrew.
Yeah, so I just sorry, I don't know if I'm barging in here.
No.
But with that amount of money, I also feel that investors didn't really understand the market. Because if you raise $86 million, there is we can kind of solve all technical issues in Africa with $86 million.
Yeah.
So investors didn't actually understand what they were buying. So, and I actually have the question that cases like this cause us now to struggle to actually even raise $500,000 because we're sitting with great technology solutions that can solve major headaches in the world, not even just in Africa. And we are struggling to get investor interest. We have all the governance in place, but now the investors that I'm meeting with is saying, no, we do startup funding and we do seed funding and we do angel funding, but you need to be operational for at least 2 years. And investors that's looking for companies that has been operating for 2 years is companies that has, if I operate for 2 years, I don't need an investor anymore. I need an investor now because to scale the operations. We have interest in share platform in more than one country in Africa. And I need investors to scale the operations. And all my governance is in place. So why am I struggling with getting investors now?
Yeah.
All my pitches is up to date. All my documentation is in order. I've got COOs, I've got CEOs, well, I'm the CEO, but I've got COOs that's looking at the operations. I've got head of finances looking at the finances. why am I struggling with getting even close to $1 million in funding?
Well, I think dynamics have changed, to be honest, especially with investors. Dynamics have changed. And I think back then we didn't have, we could have had quite a number of startups, but now we have, you know, the playing field or the ground field it's increased in terms of the number of startups. So things then were different. And like I think one of our members here said, and even with the pulling off of USAID, who would fund startups very easily as long as you're able to prove yourself, it's difficult now. And especially with this kind of cases where startups start very well and they get seed funding, but they collapse. So it's inevitable for it to be difficult to get funding.
Yes, no, I agree.
It's not impossible, but it's difficult. It's not impossible, I think, from my experience.
Well, yeah, at the rate I'm going, I'm probably going to not need funding before I actually get funding.
Okay. Okay, can proceed next. Okay, so what is your role as a founder? What decision rights do you have? What operational oversight do you really need to take in consideration? So first scenario, and maybe Andrew, you can help me with once we get the answers in the charts. So your co-founder has just committed $10,000 to a social media ad campaign without consulting you. You strongly disagree with this decision. Currently, your startup does not have a clear policy or process of approving such expenditures. So my question is, what happens next? Maybe we can get answers, different answers in the chat box. And Andrew, maybe after a few minutes, we can get to hear what people wrote. Okay, do we have significant amount of answers, Andrew? Maybe you can want to read for us, or maybe the people who've commented can read. One or two.
Yes, I can see answers from Nilesh and Hillary. Hillary's is interesting, and I'd like him to read and explain.
Okay, that's good. Hillary?
Yeah. Now. So it's not something that anyone can be willing to sacrifice. I find a lot of people, especially at our age, they have a lot of commitments around family. I want to build. They have their financial goals. Their financial goals cannot be, I build this startup for future. One of the things is instant gratification and sort of long-term thinking. That does not exist. Somebody wants in how much can we raise? How can we raise? So that is why for me, I sacrificed, paid my employees, paid everyone their market rates, and just hired the junior most employees and basically trained them from the ground up. Because at the same level operating with a founder that doesn't buy to the longevity and the long-term kind of thinking, it will not work. That's my opinion. I know that a lot of people, I've met people and it's working and that's good for them, but it just did not work. The power imbalance could not have worked, like the context you have given. And that can even be done out of spite. They can do knowing that you might disagree, but they will do it anyway. So, yeah.
Okay, perfect. Thanks, Harry.
Like that.
Harry, Harry, is it? Hillary, yes.
Hello?
Hillary,
Yes.
Sorry.
Okay.
I don't know how to put my hand up, sorry.
It's okay.
Yes, I think that in the exercise, we only have one thing around. Being a co-founder is not meaning being a CEO or a CFO or something. So I think that at the beginning, we think that being a founder. Like a founder is being a CEO. Being a founder is not being a CEO, even if you are alone. It's not about co-founder or not. It's about separating your idea or you and your moral person you create. So when you create a moral person, even if you are alone as founder, you have to have the cap of the CEO or the CFO when you do something. So to respond to the question, for me, is the co-founder, is the CEO or the CFO, and have the role of deciding of the social media campaign, nothing have to happen, nothing. For me, is that. So I think that you previously talked about the responsibilities, and even if you are alone in your head, you have to know when you are the CEO, when you are the CFO, when you are the director of marketing. Even if you are alone, if you grow like this, I think there will be a moment, yeah, that when you will know that this point, I'm like a bad CFO, I have to hire somebody. And when this person take the responsibility of doing something, we all, how can I say that? We all have the consequence of it, because even if you are in a big group, if the director of commercial director do something bad, you can just fire him the same way you can fire yourself as CEO. If like you know that I'm a good founder, but I'm not a good CEO, I can drive the vision, I can inspire people, but I'm not a good CEO, you can fire yourself. So that's my comment on this topic.
Okay, thank you so much, Virginia. I think that's really, really important what you've made mention, whereby you're saying that you don't, even if you're the founder, you don't need to be the CEO. Yeah, it rarely happens, but it is very necessary sometimes for it to happen. And you might be the vision bearer, but you don't need to be the one to be the CEO and the implementer. Anyone else would like to articulate their answer?
Yeah, I can come in. This Nilesh. So, this is a very interesting question, and this is the way it has been framed, but this is something which I, as founder, deal with day in and day out. It could be prioritizing customer A over customer B, prioritizing task A over task B, spending on this versus spending on that. I think it all fundamentally, in my view, boils down to what are the ground rules for running the organization. So obviously, I see it, is as a layered, kind of architecture. Obviously, the most lowest layer is defining the process. These are the 5 people who are going to approve. This person will have a limit up to this. This person will have a limit up to this. And, that process just gets followed, right? But that may not be possible to do it in each and every case. You can do it in terms of money, but the time of the resource is also money. If, someone decides that, oh, I'm going to work on this today, and that, half a day which a resource has put into a particular project is not a priority for the organization, that's also a waste, even if it is not a cash going out of the pocket. So this problem, I think, at least I can share the way I solve it, is laying the ground rules very clearly, the principles very clearly, and also setting the expectation that if there is a dilemma, you ask a question. Anything which is unclear, ambiguous, we take a quick decision. We are available unless someone is, indisposed, then it's a different matter. But the way I, would handle it is laying that ground principles very clearly, and also that keeps evolving because there are scenarios which keep coming up, documenting it, communicating it, so that the people are more aware about what kind of organization we are trying to build. How do we prioritize something over another? What is our strategy? What are the KPIs we are tracking? How do we want to get there? And if there is a larger understanding around those things, at least the bigger problem get resolved. And then it comes to nuances which has to be handled on case to case basis. So that, would be my input on this.
Okay. I think Nilesh, you've also really articulated it well, especially for the fact that you're saying we need to have ground rules. And those ground rules are what you were talking about in terms to have a well-documented, professionalized, formalized structure, processes, and policies that really talk about, your spending power, your spending habits. And like you've also said, it creates a culture to which the organization also follows. So in this instance, so if they've already committed to social media, I think the most important thing you need to do is to sit down, communication. And what I normally also tell people is your processes and your policies and your, like Nilesh says, your ground rules will define the culture of an organization, whether big or small, because people have different, we've come from different backgrounds, we have different experiences, we have almost different expectations with one common goal, which is the vision of the business. So what will unite us, or what will ensure that our culture is almost the same, is the defined processes and policies that you develop, or your ground rules that you develop within your businesses. And that is why policies and processes, or even, and you see, policies and processes don't have to be 10 pages or 20 pages. No, no, no. It can be a 2-pager or a 1-pager that really defines what should be done at a particular moment. So for example, in this one, in future, a DOA where an amount is of $10,000, or even for startups, any amount that has to be spent, the founder has to be informed. The CFO first has to be informed before you get to the CEO. So here we are just articulating the roles of the founder, the fact that we need to have processes and policies that unite us in terms of a common vision and mission and probably what we want to achieve. So if you allow me, I'll move to my next slide. So here we'll just look at what are some of the founders' roles, and decision-making roles. So founders are mainly, and I'm sure you've experienced this considering you're here with us now as founders and, respective people who are acting also as associate directors of founding companies, etc. So you define the problem, your mission, your purpose, and they really define the problem the startup is trying to solve. This isn't just a slogan, it's the core reason why the company exists. And that's why the founders are mainly the vision bearers. In terms of architect also, if you relate it to what you're trying to solve as a startup, you're mainly involved with the product design, the team, the model you want to take up, and also as a fundraiser. So the founder mainly, or the co-founder, is one who's going to tell the story, one who's going to tell why we exist or what problem you're trying to solve. And overall, you're a culture setter. So you set values, you set the behavior and the work ethics. So if a founder is got habits which are not really in line with integrity or respect, then ideally also the other people are going to follow because it's a culture that they're setting. In terms of decision making, so there's decision making in terms of unilateral decisions where one founder decides alone, and this is common especially with where it's just one person who's the founder. And when it comes to maybe consultative decisions, who need to be consulted before a decision is made, even if you're one founder and you have maybe a CEO, a CFO, or a finance accountant or someone like that, then those are the consultative decisions you need to make. And then consensus is where you require an unanimous founder agreement, pivoting really the business and taking investment, and even hiring, for example, or firing of co-founders. So those are some of the consensus decisions. So decision making is really what we're saying, what decision do you make at what time? And I think Nilesh touched a bit on it in terms of, do you need to make decisions as quick as possible? What kind of decisions are these that you're making? Do you need input from any person? Do you need to consult? Do you need to inform? All those are around your decision making. Quick analogies. So the founder's vision really in terms of governance and policy directly shapes the company's approach to transparency and stakeholder management. So a founder, and this is maybe where the culture comes in, a founder who believes in radical transparency will build a governance model with open communication to investors and clear policy. However, a founder who is secretive will create a closed-off culture where it's hard for them to build trust with underwriters or even regulator, and increases, you set a culture of people not being able to make decisions as quickly as possible because you're more closed off. In terms of precedent and process, if a founder personally vets every particular data that is shared or agreement to ensure compliance, they establish a culture where they're very keen on compliance and regulatory respect. If the founder cuts corners to grow faster, they establish a culture of high risk. And we've seen both of them where you're really eager to get a deal and you would want to bypass some of you're creating a culture where your team members are going to be very high risk takers because you're hungry for this thing and you want to bypass some of the key requirements that are maybe needed. So before formal policies exist, the founders' actions are really the policies, how they make the first key hires, how they handle the first customer complaint, or how reports a first set of financial sets or a powerful precedent. So this is more of how you create a culture within your business, within your organization. Okay. Great. So a case study of M-Copper. This one is public knowledge. That's why we've really put it out there. So this is M-Copper is a Kenyan founded startup. It's not now a startup, but it's really scaled up. So M-Copper offers the pay-as-you-go smartphones and embedded financial services. So they've really scaled up massively with their products. And now currently, I think they should be offering also insurance services apart from the financial services. They have significantly reached a huge number of customers. They have registered globally, they have raised significant investment, and really they have tried to structure the operation so that they can access international capital markets. So why did I pick this as a case study? One of the issues that came about with M-Copper is on the tax compliance and the tax audits they faced. So for M-Copper, they have the operations team sitting here in Kenya. However, you find that the senior and board executives sit in the UK. So their argument was that because the business, the operational control was based here in Kenya, the argument was that because it's registered far off in the UK, they will be able to avoid some of the Kenyan tax obligations. But this was not the case. When they took it to the tribunal, and you see, by the time you're getting to the tribunal, you've really had some share of, tax people in your face and some negotiations happening. But by the time you're getting to the tribunal, then it means that it becomes a case where you don't know how it will go. So what was decided is that because decision makers reside in Kenya, so we have the CEO, the CFO, another key management team who are based in Kenya, operational control was in Kenya, making them liable. So this reflects a governance decision or oversight about where boards, senior executives, and operational leadership are physically situated, making them subject to local regulation and tax. You can you can go and read through. They were fined quite heftily, and they didn't have an option, but I think they should have paid. And so this clearly tells us that governance is just not about policies and processes. It also speaks to the fact that you have to really understand the markets, especially if you're scaling. I don't know, there's somebody who's scaling to Africa. You need to understand the dynamics we have in different countries. Personally, having worked in in more than 14 countries, I can tell you that some countries are very, very stringent on regulatory. Tanzania is extremely stringent on regulatory if you compare it to Kenya. Kenya also has its own share of changes in regulatory from tax to other aspects of it. If you go to places like DRC, it's a different whole story. If you go to South Sudan, governments wake up and introduce tax regulations which you never heard of. So what I'm just saying is that you really need to know your operational environment, your regulatory requirements, and before you even get into a market, you need to really do your homework thoroughly in terms of what taxes apply and what regulatory, and not just one or two, but what other regulatory compliance you need to face. I think, I don't know if there's a question or a comment. Or if you have any question or comments or any experience where you've had with anything similar to this, maybe you can chip in before we proceed.
Yeah, I can come in. So basically, this my question here is that, there are intricacies of, the taxation, and in this particular case, the permanent establishment, right? And what goes into deciding where does the PE reside. As founders, one can't be expert in this. Important is to have right advisors, who can advise on these matters. But from a founder perspective, I think the larger question is, how do founders decide what yardstick or principles they apply? Because, one of the challenges I've personally seen, nowhere else in the world you have the taxation level which is actually prevalent here. And I'll talk about Uganda. Anything is, you buy a service, you sell a service, everything is 18% taxed. On top of that, there's a withholding tax, which could be anywhere between 10 to 15%, which you have to make a payment, deposit it here if the money is going out of the country, even if to you as a royalty, as a technical services, as management. So if you put all those things together, and this excludes the, the 30% taxation, income tax or corporate taxation, which is there. So there is a very high degree of taxation, which is there. And there's the bigger question which always comes to a founder's mind is that, okay, is there a way in which I can quote unquote manage it, right? Looking at loopholes. Okay, can I, do things in a way where, it's a gray area, and I can decide to, handle it in a particular way. So I think those aspects of the decision and the yardstick which a founder applies become very critical, in the environment. But in terms of subject matter knowledge, I'm not sure, to be fair, Sharon, if a founder can be expert in the tax matters.
Definitely, and that's why you initially, when you started your statement, you said it's very important to have advisors, and that's what we're getting into. You, as a founder, you can't know everything. Most founders, you're specialized in your own, that's whole expertise, and that's why it's important to have different advisors with different expertise. And when we get into that slide, we'll be able to see what's the difference. And it is, I don't want to say it is inevitable, but for the taxman, you just never know if they're there to, because even if these people had a CFO, yeah, why did he not or she pick this up? Yeah. So those are some of the questions, but
Yeah, I think the
yeah.
larger question why, because I'm sure the CEO, it's a $400 million company. Yes, they said they're profitable by $15 million. So definitely they're not a startup, and they have the luxury of getting, inputs from wherever they want to get it, from the KPMGs and the PwCs of the world. So I'm sure all that would have been on the table.
Yeah.
I think the larger question is that the judgment call which the CEO or, the CFO or the board took to say, okay, we will take this line of action. And that's where perhaps the error lied, if we can call it that.
Yes. Totally agree with you. Totally agree with you. Okay, thank you so much. So if you allow me to proceed, I know we have 30 minutes, but we are almost there. Should be the second last slide, not slide, but session, but can I say chapter? So here we look at advisory and fiduciary board. So understanding the difference, the timing, the roles and responsibility, and building the right board at the right time. So what's the difference? So an advisory board is really an informal group of experts. I think we've really articulated this during our whole discussion today, who guide and mentor and open networks. So here we don't have any legal responsibility. But for the fiduciary board members or board of directors, legally recognized body with duties to shareholders, regulators, and other stakeholders. So for the advisory board, the significant difference is on the legal responsibility. For the fiduciary board, I know for sure, some of the decisions that are made within a business have to be approved by the board. And that's why I think should be Mwenda was really not impressed with having to wait for every quarter for you to meet board of directors. But for the advisory board or advisors, it's a group of experts. So you pick an accountant or somebody with an accounting background. You have somebody who's an expert in legal and regulatory, maybe has an investment experience. You pick different number of people who come and form in your advisors. And your advisors are really best at early stages because they provide mentorship and they provide industry knowledge and they provide credibility. And for advisors, from my experience, and especially I have friends who sit as advisory board members, is that you can engage them formally, but frequently. So you don't need to wait for 3 months to formally engage them, no. And that is where the beauty is. And I think for each and every startup, it's very, very key, not even maybe when you're starting, but it's key to have and to grow your advisors as you go on. I think sometimes you might ask yourself the cost. Like I initially mentioned, we have a lot of experts who are willing to do this work in terms of advisory because they're also building their own portfolio, from my experience, for either very small fee or sometimes even voluntary. So it's something probably you all need to consider if you don't have one. And we'll be able to, I think we'll have some takeaways which Andrew is going to share later in terms of what are some of the TORs you can have for an advisory board. So a quick example is a fintech startup forms an advisory board of bankers and tech experts to really refine their strategy. Later, when raising institutional capital, they establish now a fiduciary board. So a startup will need an advisory because it provides expertise, credibility, and network, and advisors really guide the founders on strategy. A startup is like a young athlete training for the Olympics. So the advisory board really is like a coach for the team, where the trainers, nutritionists, and mentors who really provide advice, techniques, and encouragement, but they don't run the race. So that's a good example I thought I would share with you in terms of what's the difference. So for the fiduciary board, you're actually legally liable. It's called fiduciary responsibility, where you're legally and ethically responsible as a person of trust who has to act in the best interest of the organization, the shareholders, the regulators, and all the respective stakeholders. So that is the significant difference. I hope, Mwenda, this is now clearer?
Yes, it is. Thank you.
Okay. So who is your personal board of directors? So this is the advisor, and I think we've really articulated this. So where you need your advisors at an early stage, and then when to create an advisory board is now. You don't need permission. You just identify 2 to 3 people with experience in areas probably you lack as a founder. And then how do you engage them? You send maybe a one-pager, or you within your networks, you can get introduced, your associations, so industry-specific bodies, for example, your IRAs. Here we have insurance regulators, fintech networks, investor connections, and platforms of community where you can actually get people who have expertise in areas probably you're not good at. So if it's regulatory or it's finance or it's other areas, then you can engage them on these platforms. I think all you just need to do is to know how to approach them and know how to articulate the reason as to why you probably need them on the advisory board. And it's also sometimes good to even stipulate the duration you might need them. You might say it's 1 year, or you might say it's 2 years, so that they also know that they'll be committed to you within this period. I think the only challenge with this is if depending on the people you bring on board, they can break or make you. Because remember, advisory boards are advisors, are mentors, and as we all know, some might not be the best. And that's why advisory is different. You might drop them. You're allowed to drop them or to even change, not really drop them, but changing them based on maybe your interaction, maybe you've not gelled well. It's easier to replace advisory board members than fiduciary board members, because sometimes fiduciary board members are appointed by shareholders. Some have to be there and have to need regulatory approval. So it's a very challenging process for recruitment of fiduciary board members. Okay, so just a quick case study, just to show how the transition from an advisory to a fiduciary board membership. So when Andela, so this one is based in Nigeria, was founded in 2014. It began as a talent accelerator focused on training African software developers and connecting them with global companies. Being an early stage startup, it did not yet need the heavy structure of a fiduciary board with legal and duties and responsibilities. Instead, the founders leaned on an advisory board for strategic guidance. So the advisory board really gave founders guidance on scaling, and some advisory people will actually give you, they'll open their networks to investors, and then also provide mentorship to leadership team on global HR practices. So this is particularly for Andela. So in this instance, at now they've really grown. If you Google them, they're no longer startup, and now they have a full-fledged board members who have the legal duty or to oversee financial stewardship, protect shareholder interest, and really guide the company towards profitability and sustainability. So you can always read through this in terms of when you have time to see how they transitioned, the challenges they faced, and where they are right now, and what the difference with what they started and what they currently have. Okay, allow me to go to financial hygiene. This will be a quick one in terms of separation of personal and business finances, cash flow discipline and record keeping, and compliance and tax responsibility. So one of the most common pitfalls in early stages ventures, we've talked about it, is mixing of personal and company money. So a founder may use the company card for groceries or pay rent out of the business account, thinking they'll sort it later. But once you start and you develop that habit, it's inevitable for you to actually track back and correct some of these things. So in this instance, governance is important because it really creates accountability. When investors or even auditors review your books and they see confusion, then the mistrust also starts. So for example, a Kenya fintech startup really failed a due diligence review because its founder had been paying family medical bills through the business account. An investor flagged it as poor governance and ideally walked away because of that. For this, what was supposed to be done, open a dedicated business account from day one. Even if the business is small, this sets the tone of discipline and respect for stakeholders. An analogy which I thought it was very interesting is that imagining you're brushing your teeth with cooking oil instead of toothpaste. Both are edible, but one clearly doesn't belong there. And that's where the mixing of business and personal finances really inconvenience in the short feels convenient in the short term, but it erodes governance and the health in the long term. Any questions in terms of this? I believe from where we are, we really know the importance of separating personal and business finances. If none, we'll move forward. So practice cash flow discipline. From my experience, I know one of the thing is cash flow. Cash flow in terms of just trying to get the numbers right, yeah? In most businesses, especially SMEs, you find that they are existing. At the end of the month, the person says, but Sharon, I really don't know where the cash is. I don't know what happened. I'm making revenues on paper, but I can't see where the cash is going. So revenue projections are really exciting. However, cash is king. It's very important that you need to know at least how to prepare cash flow. And a cash flow, cash is cash. Yeah, it's different from your revenues. So it means you know where your cash is, where it's going, and what's left to sustain operation. So why this governance issue is important is if a board or even an advisory board cannot see cash flow, or even you as a founder, and you cannot really hold your management accountable or make informed decisions, then there is a problem. Yeah, that particular matrix in terms of cash flow is a very, very key. And it's like the blood of the business. So if it starts drying up but your revenues are showing that you're making money, then that's a flag, or should I say a red flag, that something is going wrong. So a good example is a food delivery startup in Lagos had solid growth, but nearly collapsed because it didn't track a 3-month cash flow. Salaries bounced and trust eroded amongst employees. An advisor stepped in to build a 13-week rolling cash flow tool that gave the board and founders visibility, and within months, they were able to regain control. So we have tools which you can use. Once again, I'm going to be able to share this with Andrew, and he'll be able to share it with you. Some of our handouts or takeaways which you can use. Or if you have something in place, perfect. I think the most important thing is consistency in terms of how you use it. So a good governance fix is just reporting cash flow alongside profit and loss, and governance bodies must review short-term cash forecast at least monthly, or even, for me, I would even think a weekly review of your cash status is very important to be able to know where you're leaking or probably where you need to tighten your screws. Keep reliable and transparent records. In early days, founders wear many hats, but without defined rules, money gets spent recklessly and you might not be able to track it. So for example, who approves purchases? Who signs off new hires? And why is this a governance issue? Because once you have a weak spending control, this can lead to misuse of funds. And then at the end of the month, you have no idea if you have any leakages within your business, or you spent in areas where you're not supposed to spend. And that's why also you have budgets that come in, which have to be well documented. They have to be well structured. So a good fix is that you build spending controls into your governance frameworks early, even if approvals are just between two founders. Have budgets. You can, depending on your spend, you can have bi-weekly or weekly review of your budget, how you spend, what you have in your account, what you intend to achieve, and at the end of the month, you check your operational cost and if your cash can actually meet some of these costs. Stay compliant with taxes and regulations. Sometimes we think that we are too small for the tax man, and that's dangerous, and that's an assumption. And non-compliance can result in penalties, reputational damage, and even shutdowns. We've had businesses who've shut down because they have failed to pay penalties which were slapped on them because of non-compliance of tax obligations. And that should be it. I don't know if we have any questions, maybe the last 2 slides in terms of advisory and board, and then in terms of your financial hygiene. Okay, if there are no questions, Andrew, back to you, or should we have maybe a roundup? I'm not sure.
Hi, Sharon. My apologies to everyone. I am at a cafeteria. I think this has been a good session. Normally, if there are any questions or follow-ups, please anyone get back to me. I can share Sharon's contacts, and maybe if Sharon, you will be so kind, maybe to indulge some of our cohort in the questions that they're going to ask. Otherwise, normally we just do a roundup of the session around this time. And if we have some more minutes, we have 17 more minutes, 16 now, we can give them back their time. And then we can end the session here if there are no more questions or comments.
Okay, Pete says he has no question.
Any questions, team? Once. Once. Then I think, Sharon, we will
Okay.
end there. I just want to thank you for a good session today. And we'll see you on the interwebs. And yeah, any further, any more? Yeah, I can see none from, I mean, no questions, very good session. So
Okay.
we'll meet on the interwebs on email. Thank you for preparing really well, and I wish you a good evening, and everyone also, I wish you a good time depending on your time zone.
Thank you so much, Andrew, and thank you everyone for your time. I wish you all the best. It's a very strong team from the introduction. I'll definitely share my contact details. Please reach out where you need help or where you need clarification or where you need support. I believe that's why we are here, Andrew. And like Andrew says, take care and be blessed. Thank you so much.
Thank you, Sharon. Bye-bye, team.
Thank you. Bye-bye.